Gold just did something that should make everything else on the screen feel slightly less important. Because when the world's oldest form of money starts moving like a momentum asset, when it stops acting calm and starts acting urgent, something underneath the global system is shifting. On January 26, 2026, gold pushed through the psychological ceiling of $5,000 and printed around $5,100 an ounce. $5,100 for a single ounce. Not a bar, not a kilo, 1 ounce. And in the same wave of price discovery, reports showed intraday prints pushing even higher, around $5,111 and change, before price steadied nearer $5,091. That kind of range isn't just volatility. It's a market trying to figure out what the new normal is, in real time. Here's the part that should make attention lock in. Gold is not supposed to move like this. Gold is supposed to be the slow, steady anchor, the hedge, the insurance policy that quietly does its job when everything else is loud. So when gold starts ripping, when it moves in big, sharp steps, this is not just a story about a metal. This is a story about trust. And the reason the next stretch of 2026 matters is simple. When a safe haven moves like a risk asset, it usually means confidence in something bigger is cracking. Policy credibility, currency stability, geopolitical calm, or all of the above at the same time. Stop, because the headline number is flashy. But the real story is how the gold pricing machine works, and what it takes to move it this violently. Gold price is often described as spot, meaning the price for immediate delivery in the wholesale market. Spot is supposed to be the closest thing to physical reality. But gold doesn't get priced in a single place by a single group of people. The price is a tug-of-war between spot and future. It's between physical demand and leverage positioning, between real metal and paper contracts. And the center of that paper world for many participants is COMEX Gold Futures. COMEX is a futures marketplace where standardized gold contracts trade with margin requirements, meaning a participant can control a large notional amount of gold with a smaller amount of capital posted as collateral. That leverage is not automatically bad. Leverage adds liquidity and helps price discovery. But leverage also means something important. It means price can move fast when positioning shifts. It means a market can explode higher when risk managers scramble to hedge, when short positions get squeezed, when volatility forces repositioning, or when a macro shock pushes capital into the one asset that doesn't rely on anyone's promise. And once that move starts, once the trend establishes itself, feedback loops take over. Price rises, volatility rises, margin changes, positioning adjusts, and the next wave of buying or forced covering hits, pushing price further. That's how a market that usually feels measured can suddenly feel violent. Now ask a simple question. What kind of environment produces a gold market that can rip into 5,000 territory and print 5,100 in the same breath? Because this wasn't just a random spike in a sleepy market. Earlier in January, COMEX gold futures were already printing record highs. Reports noted February gold futures hitting around $4,891 and change at a prior peak. So the 5,100 moment was not an isolated candle. It was an extension of a move that already had momentum, already had narrative fuel, and already had capital flows behind it. And the narrative fuel matters because markets are not spreadsheets. They're human behavior, incentives, fear, and liquidity, all compressed into a number. Around this late January surge, reporting tied the move to a combination of political uncertainty, geopolitical stress, and broad market instability, exactly the kind of cocktail that drives safe haven demand. Because gold does best when the question isn't just what will inflation be next quarter. Gold does best when the question becomes, quietly at first, then loudly, can the system be trusted? That is the difference between an inflation trade and a confidence trade. And confidence trades are the ones that can reprice the world. Here's why. Gold is a non-yielding asset. It doesn't pay interest. It doesn't produce cash flow. In calm times, that looks like a disadvantage. In unstable times, that becomes an advantage. Because gold does not require a promise. It doesn't need a central bank to remain disciplined. It doesn't need a government to manage debt responsibly. It doesn't need a company to hit earnings. It simply exists, and it settles. So when fear rises, or when trust falls, capital migrates to the asset that does not depend on a counterparty. And this is where it gets really interesting, because the story under gold in recent years has not been only retail demand or speculative trading. A major part of the foundation has been central bank accumulation. According to the World Gold Council, central banks added 1,045 tons of gold in 2024, and central bank demand topped 1,000 tons for the third year in a row. Say that again, central banks, the institutions that issue and manage currencies, have been stacking the asset that has no issuer. And the World Gold Council also reported total annual gold demand reaching a record, around 4,974 tons in 2024, when including over-the-counter investment. These are structural numbers. These are not mood swings. That kind of demand acts like a slow, steady hand under the market, tightening the available float over time. And when the available float tightens, it takes less incremental stress to move price. Think about it for a moment. Gold supply doesn't expand overnight just because price spikes. Mines take years to develop. Recycling responds to price, yes, but it does not double instantly. So when investment demand and reserve demand push higher together, price becomes the adjustment mechanism. And that adjustment mechanism can get ugly in both directions. Now zoom out, because a move like this always triggers the same debate. Is this the start of a new era or the peak of a blow-off? The honest answer is that the chart alone won't tell the full story in the moment. But history can help frame what a confident shift looks like. The late 1970s into January 1980 is one of the most cited parallels for a reason. Gold ran hard into a major macro panic cycle, peaking around $850 an ounce at the time, driven by inflation fears and geopolitical tension. The numbers are different today, obviously. The global economy is larger. Debt levels are larger. Derivatives markets are larger. The financial system is more complex. But the psychology can rhyme. The rhyme is this. There are periods when the crowd believes the old assumptions are safe. And there are periods when the crowd decides the old assumptions are not safe and reprices everything. Gold tends to behave differently in that second phase. And that is why the 2026 surge alert is not really about a single print at 5,100. It's about whether the world is transitioning into a sustained confidence repricing cycle. And there are signals that point in that direction. One report described the move as stunning even to strategists, noting gold gained roughly 65% in 2025 and was up around 18% so far in 2026 at the time of reporting. Those are not typical gold numbers. Those are equity-style numbers. So the first implication is straightforward. Volatility is no longer optional in gold. A gold market that can do that can also do sharp pullbacks. And this is where conventional thinking gets it completely wrong. Many people assume a bull market means smooth upside. In reality, the strongest bull phases often include the nastiest shakeouts. Because as price rises, leverage builds. As leverage builds, fragility builds. And when fragility builds, even small shocks can trigger large forced moves. This is why understanding the mechanics matters. Spot versus futures. Spot is the price for immediate delivery. Futures are contracts for delivery at a later date, and they trade based on expectations, hedging pressure, funding conditions, and positioning. In normal conditions, futures can trade above spot, called contango, partly due to carrying costs and interest rates. In stressed conditions, near-dated pricing can tighten relative to later-dated pricing, sometimes flipping into backwardation, often interpreted as a sign of immediate demand stress. That structure becomes a clue, not a prophecy, but a clue. Because when the front end tightens and volatility spikes, it signals a market under pressure to settle near-term needs. Now add one more layer: liquidity. Liquidity is the ability to transact without moving price too much. In calm markets, liquidity feels endless. In stressed markets, liquidity disappears right when it's most needed. And when liquidity thins at the same moment that volatility rises, price can gap. That's how a market prints 5,100 and then whips around hundreds of dollars. So what is the deeper thesis behind a move like this? This is not just inflation. This is not just gold is shiny. This is the market placing a higher price on settlement certainty in a world that feels less certain. It's a repricing of trust. And that trust repricing has multiple inputs: geopolitical risk, political uncertainty, debt dynamics, currency credibility, and cross-asset instability. When those inputs stack, when they align, gold doesn't climb, gold launches. But, and this is mandatory, there is a bearish case. And the bearish case must be respected because ignoring it is how people get emotionally trapped at the worst possible time. Here is the bearish case, clean and direct. First, parabolic moves invite violent pullbacks. When price runs too far too fast, profit-taking becomes rational. Funds rebalance. Traders de-risk. Risk managers reduce exposure, and volatility triggers mechanical selling in certain strategies. Second, correlations can flip in stress. If there is a sudden global dash for dollars, or if real yields rise sharply, gold can correct even if the longer-term thesis remains intact. Third, policy responses and intervention risk are real. Sometimes that's direct. Sometimes it's indirect through liquidity actions, regulation, messaging, or market structure changes. When gold becomes a symbol of distrust, the system often tries to restore confidence. And those attempts can create sharp counter-trend moves. Fourth, positioning can get crowded. When too many leveraged participants share the same trade, the unwind can be brutal. Being right on fundamentals does not protect against timing risk. And fifth, technical exhaustion is a thing. Even in strong bull markets, price can get stretched far above trend measures like moving averages, making mean reversion risk higher. So yes, 5,100 can be a signal of strength. It can also be a short-term stretch. Those can both be true. This is why the most useful approach is scenario thinking, not prophecy. Scenario 1, continuation with consolidation. Price holds the 5,000 region, chops, digests, shakes out leverage, and then continues higher later as macro drivers remain elevated. Scenario 2, sharp correction, then recovery. Price drops hard back toward prior breakout zones, levels in the high 4,000s, then stabilizes as longer-term buyers step in and the big drivers persist. Scenario 3, blow off top, price overshoots dramatically, sentiment becomes euphoric, and the market spends months unwinding. That third scenario tends to require peak narrative intensity and a widespread belief that downside is impossible. So which scenario is most likely? The evidence points to a market with both speculative momentum and structural demand. Safe haven demand tied to uncertainty, reported widely, and central bank accumulation, a multi-year foundation. That combination can produce sustained strength, with violent pullbacks along the way. So how to read the next phase without getting trapped by emotion? Start with the anchor level. 5,000 is not magic, but it is psychological. When a market breaks a major round number, it becomes a reference point for everyone. If price revisits 5,000 and buyers defend it repeatedly, that's a sign of a regime shift holding. If price loses 5,000 and fails to reclaim it, that suggests the breakout may need more time to build support. Next, watch the macro catalyst stream. Is uncertainty rising or calming? Are political and geopolitical risks escalating or stabilizing? Are rates and real yields moving in a direction that supports gold or challenges it? These inputs matter more than any single candle. Then, watch volatility itself. A market can stay bullish while volatility rises, but rising volatility increases the probability of sharp drawdowns. And sharp drawdowns are where people make their worst decisions, selling in panic, chasing rebounds, or sizing positions too large because it can't possibly go down. That is the trap. Now, implications for different kinds of participants, without turning into advice. For physical holders, the move validates gold's role as long-term insurance, but it also introduces practical friction, premiums, spreads, custody considerations, and emotional discipline. A long-term hedge becomes less effective if it is treated like a short-term lottery ticket. For traders, this is an environment of opportunity and danger at the same time. Big ranges can create big potential. Big ranges can also erase accounts quickly if risk is not controlled. The market that prints 5,100 can also print a $200 drop with no warning. For long-term allocators, this is a reminder that gold can behave as a hedge when trust is questioned, but it is also a reminder that rebalancing and risk management matter. For new entrants, the key advantage is education, understanding spot versus futures, understanding how leverage and margin can accelerate moves, understanding why central bank demand creates a structural floor over time, understanding that the price is not just a number, it's a signal of the world's stress level. Now pause, because one more overlooked point matters. A gold surge is not purely good news. It can be a symptom. It can reflect instability. So the deeper question is not only how high can it go? The deeper question is, what is the world saying when it values settlement certainty this highly? And that question is exactly why gold at 5,100 feels different. Because at that level, gold is not just a hedge. Gold becomes a headline that forces people to think about the credibility of the system itself. And that is the moment when the gold story stops being niche. It becomes macro. Now, verification matters. Do not rely on a single narrative. Cross-check price feeds. Read multiple reputable reports on the catalysts. Review primary market infrastructure sources to understand contract specs, settlement, and how the futures market transmits signals to the spot market. Because education is the edge, especially when a market enters price discovery above a major psychological threshold. Now, risk disclosure clearly stated. Gold is volatile. Gold can gap on headlines. Gold can experience sharp drawdowns even during powerful long-term uptrends. There are no guarantees. Nothing here is financial advice. Independent research is essential, and risk management is non-negotiable. And now, the 3 core takeaways that matter most. First, gold does not move like this unless the market is repricing something bigger than a single economic data point. Second, mechanics create the violence. Leverage, liquidity, margin, and positioning can turn concern into a sudden surge. Third, structural demand, especially multi-year central bank accumulation and record demand trends, can underpin the move. But short-term price action can still be unforgiving. So here's the final thought. Let it land. Gold at 5,100 is not just a milestone. It's a message. It's the market saying that trust, currency trust, policy trust, geopolitical trust has become more expensive. And whether the next step is continuation or correction first, the signal is the same. When gold starts screaming, don't just watch the price. Listen to what the world is afraid of.